Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Welcome to the Market Chameleon pre-market show with myself, Will McBride, and the best chameleon of all, Dimitri Pargamonic. How you doing, Dima?
Hey, Will, how's it going?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor or your broker-dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. What's happening in the pre-market, my friend?
Yep, let's take a look at the pre-market and a couple things for today. We are doing a webinar with Interactive Brokers at 2 o'clock.
We are.
Yep. So I'm going to talk about earnings moves, and I'm going to focus on a couple new features reports that we just put out. And these are under the earnings here. Take a look here.
For anyone who doesn't know, I'm putting that link in the YouTube chat for the webinar. That's an Interactive Brokers webinar. So it lives on their website, and you have to register either to watch it at a later date or to, register to see it today. So I'm going to put it in the link.
Right. So this won't be on YouTube like we usually do, or how we organize it, because it will be through Interactive Brokers platform. And it's under the earnings. These are the three new reports: implied move charts, straddle performance, and earnings stock moves. And I'll explain it more. I'm not going to go into it now because we're going to do a webinar on it. But what we did was, for today, if you guys are new or you're not on the premium features, it is open, so you guys could come in there and take a look. And we'll leave it there for a couple days, maybe just people start taking a look, and based on that feedback, we'll see how we start developing it. But the idea is that we'll start offering a lot more insights on earnings moves, earnings performance. You could kind of click in there, take a look right now. We kind of put notes in here, just highlighting some of the things that we thought was important within this analysis. But if this looks good, and based on the feedback we get, we'll start adding more insightful reports that I think will be extremely helpful when you're starting to organize your strategies around earnings. So these are insights from historical perspective. So that's going to be at 2 o'clock today. And what I'll do for now is, as usual, this morning, we're open to questions. So if you guys have any questions, about Market Chameleon tools, analytics, data, strategies, things that you've been doing that you'd like to share with us that are working for you, maybe things that you tried did not work out for you, you want to ask questions about it. A couple ways to do it: put your question in the live chat. Will's monitoring it. He'll read it back to me, or we also put out a link to Zoom on that live chat. If you click on that link, it'll take you over to Zoom. You could click on raise your hand, then we'll turn you on. You could ask your question directly and live. You don't have to turn on your video camera, but those are the two ways to ask it. And while we're waiting for any questions to queue up, we'll start on the pre-market report just to see what's trading in the pre-market hours. Maybe I'll look at a couple things on volatility, because we are in a volatile market, and I do think that this volatility is going to persist and continue. So I think that's going to be important, to kind of pay attention to the volatilities, understanding volatility and the different metrics and analytics we have regarding the volatility, I think will be helpful.
Yeah, so, speaking of volatility, when you have increased volatility, people start to show up exposed to risk. Rob just said news this morning that London Metals Exchange is closed due to a big margin call on a Chinese nickel trader who shorted it.
Right. Yep.
I mean,
so that's what's going to happen is, with volatility, it starts to shake out people, especially with larger or exposed positions, even positions people think are hedged. A lot of some of these models are not going to work in a very volatile market, right? So you might have an imperfect hedge, or things that used to be correlated might stop being correlated, and things that traded together may not. So a lot of things here become more dangerous because you can have forced liquidations. That's what we kind of see with when we get a lot of volatility. All of a sudden, somewhere out there, you don't know where, and there are a lot of complex, our financial systems are complex. A lot of things out there are floating around paper that are actually even in like our shadow banking system that might blow up. And that's what happened in 2008, right? In 2008, it wasn't even the issue wasn't on the listed exchange. So nothing, the problem wasn't on stocks or options or anything that traded on the exchanges. The problem was in the banking system itself, with these different types of products that they create and trade amongst themselves and guarantee. And these credit default swaps were being traded internally between banks. So,
well, closing an entire exchange middle of the week doesn't sound good.
It doesn't sound good. And I think I was just reading that America might like do an oil embargo on Russia. And that we'll see how that plays out. The next thing is they might kick Russia out of the SWIFT, and we don't know how that plays out, because the more I think that the initial sanctions that they put on, they were very comfortable with. They had it pre-planned, and they thought with those sanctions, they were aimed at maximizing the economic pressure on Russia, with minimal impact on American businesses, European businesses, and so forth. Now, they're not so sure, I think, because I think that they basically unleashed all those. Here, now we're getting into, I think, areas where they're not so sure, and things are very interconnected, right? We're in a global economy, things are interconnected, and we don't know how will impact. I think there's going to be a lot of uncertainty. We're fighting the Cold War again, right? Doesn't it feel like that now? Well,
I think certainly everything's changed. How countries deal with each other, it's completely changed, and so trade, everything is being repriced.
Yeah,
I mean, it's amazing. I go by my gas station every day. The price was, I think, $3.70 a week ago. It's now $4.60.
Right. Yeah, and that's why we kind of start talking about and bringing it up, because I think that this war, at least from the United States side, it's being fought economically, which means we got to pay attention, right? What is going to get impacted? How do you protect yourself? How do you position yourself? Because now we have a lot of uncertainty, in an economic warfare. So we'll talk more about it, every day, especially there's always new news coming out. So you have to kind of keep up with that. But for now, let's take a look at the pre-market report, just so we have more time if there are questions coming in. And we'll take a look at some of the, volatility metrics. So this is the pre-market report, and these are stocks that are trading in the pre-market hours. I kind of want to emphasize these are actual trades. These are actual volumes happening in pre-market. Once in a while, I get these emails, strange emails, thinking this is like a I don't know, like an anticipation of where the stock is going to go, the rest of the day. No, these are actual trades. We're not making them up. These are actual trades happening in pre-market hours. They're buyers and sellers.
Hey, D, your mic's a little staticky. You want to try plugging it in?
Let me try this. Hold on.
Yeah, that
just
sounds better.
Okay.
Yeah, perfect.
So, right. So these are actual trades happening in pre-market hours. actual volumes. So keep that in mind. We have a list of our most active stocks, list of biggest percentage gainers, biggest percentage decliners. And coming down here, I see 188 made our percentage gainers list, 40 on the percentage decliners list. So looking at that list right now, we look like we're setting up for more bullish bias at the open. So I'm going to filter out this list and take a look at the S&P 500 stocks to see if we see a similar situation there. Using these filters above in ETF, I'm going to drop this down. This allows me to select one of the ETFs. By doing that, the list below will get filtered by the holdings in that ETF. So SPY, S&P 500 ETF, these are SPY holdings. And I see 27 made the percentage gainers list, 3 on the decliners. And there we're setting up again for more bullish bias at the open and just kind of eyeballing, recognizing the symbols. A lot of them, the same theme we've been seeing are energy stocks or material stocks, related to energy, right? Anything servicing the energy. So a lot of them are on that list, and that's not a surprise because I think oil's up again, I believe. Is that correct, Will? Especially with the news about the oil embargo.
Yeah, it continues to trend higher. That's for sure.
Okay. So what I'll do is we took a snapshot we started to look at a snapshot yesterday of the SPY S&P 500 and then the S&P 500 sector ETFs. So these are actual ETFs, right, of this, and these are sectors of the SPY. Okay, so all these ETFs, right, are broken down and have the holdings of SPY. So these are SPY holdings, but then they group them into sectors. So you could see these are the sector names here. And we did talk about yesterday that energy, XLE, that's been really the star performer in the last 3 months, up 33% just in the last 3 months alone. And then you could see which other ones have been getting hit the most. Technology, consumer discretionary, really getting hit. And SPY last 3 months down 10%, but still for the year, on a 1 year basis, right? On a 1 year basis, up 9.3%. And I think that this is really holding up the SPY right here, the XLE energy sector. So we kind of stopped there yesterday, and I'm just going to kind of come up here and up top. This is where the implied volatilities are. So SPY, and then for each of these sector ETFs, this is the implied volatility levels over here. Yesterday, we could see they were all up. Some were up more than others, but they were all up yesterday. So the implied volatilities, the market was down significant. I believe it was down over 2%. Well, I think it closed at the low of the day, but really big down day yesterday. And here we kind of could also see the range in the last 52 weeks. So the implied volatility in SPY was as low as 10.5, as high as 27.8. So that was the previous, right? That's comparing it to the 52-week high low prior to yesterday. So you can see yesterday that it went above that, right? So we could see the range yesterday, and over here we see all of them right now are 100 percentile rank, which means wherever they closed at yesterday, that's the highest they've been in the last 52 weeks, because that's saying that 100% of the observations, so we take daily observations of the implied volatility and say how many of those observations were below the last implied volatility, and you could see they're all 100%. So they're all above the previous 52-week high. Okay, so that's how we're reading this, and everything's elevated. And to kind of give you a chart, an idea how the implied vols compared to previous 52 weeks, you see here SPY. This bar here, this shows you the low, the high, and the range, right? So you could see here the very low, the very high in the previous 52 weeks, and then you see that little dot, that's the most recent, so it's above there. So you could see here really quickly, XLE, the energy sector, which tends to be, by the way, in the last 52 weeks, one of the highest as far as implied volatility levels goes, jumped all the way out here. So you can see here, XLE above that 52-week high. And this is a quick way just to kind of compare the entire group relative to each other, and and then to see each individual where it is versus last 52 weeks. So hopefully that makes sense. So you got the table here and then the visual here. And again, you're looking at the group of all the sector ETFs in S&P 500 plus the S&P 500. And then where these little red dots is, where's the implied volatility, the last implied volatility, the 30-day IV, and those bars are showing you for each of those symbols the range of the implied volatility in the last 52 weeks. Does that make sense to anybody have questions on that, Will?
No, everyone seems to get it, D.
Okay. So a couple things with the implied volatility. If we look at this implied volatility level, what does implied volatility tell us? Well, it's a derived value using the option pricing model, whether it's Black-Scholes or binomial, trinomial. It's a derived value from option prices. And there are two ways we could kind of look at it. We could say the implied volatility is basically telling us what the options are predicting average daily volatility going forward of the stock. So remember, these are average daily volatility. So if the stock, opens on, and it depends how you calculate volatility, right? But a volatility could be the stock opens at 100, moves intraday to 110, then down to 90. If it closes at 100, even though it closed at the same price, intraday it had a lot of volatility, right? So when we measure volatility, it's also how are you measuring it? Are you using open, high, low, close prices? Are you using close to close, right? That also comes into play. But again, implied volatility is average daily volatility. We could also look at, well, what is the straddle pricing the move, right? What does it think that the stock, if it's 100 today for using 30-day IV, in 30 days, where does it think the stock could move from here up or down, right? That's what the straddle's telling us. So it's not trading average daily volatility, but just saying, I did nothing, I didn't re-hedge, I didn't do anything. If I bought the straddle, how much does it have to move up or down for me to break even? And how much does it have to move above for me to be profitable from the buy side? So that is where we created the, I'll use SPY as an example. And that's where we created the benchmark of the cost of this straddle. So under here, under options, under SPY, I click on options, and we have our strategy benchmarks. And it's a different way of looking at, how much premium is actually being priced into these options. And let's look at the straddle. And what is the straddle? The straddle is if you're buying a call, buying a put, right? Then the stock has to move by enough up or down to cover the entire cost of both the call and the put, right? So if it moves up, that means that the put will be worthless at expiration. That means the call has to make up for the cost of the premium that you pay for the call and the put. right? And then it becomes profitable. If it moves to the downside, the call will be worthless, but the put has to make up for the price, the premium of what you pay for the call and the put before it becomes profitable. So looking at the benchmarks here, if we look at the SPY, a 30-day straddle, right? Because each straddle will be priced differently based on days to expiration. Something that's 1 day or 2 days to expiration will not be the same price as something 30 days out, right? So 30 days out, you have more days to go, it will be priced higher. So if we look at a constant maturity, 30 days, and we say, what is typically in SPY a 30-day straddle cost, right? And that's this 52-week average, 3.5%. So usually if you're looking at an SPY straddle using the last 252 days, on average, the call and the put, you're paying about 3.5%. That's the move you would need to break even. Above that, you'd need to be, above 3.5%, it would be profitable. And we kind of see the chart here. This is how it moved around the straddle. And you can see here that 3.5%, that's the average, right? So yesterday, where did that straddle close? And that's 6.7%. So you could see here that how much higher, right? And we could see it on a graph, how much higher it was from history. So now that straddle is pricing in a 6.7% move in the next 30 calendar days. Okay. And we could compare that also to, 60 days. Right. So there's 60 days, 9.1% versus 5.2, 90 days, 10.8% versus 6.6. So you can see it's starting, how high it's starting to be. 120 days, 12.2 versus 7.9. Okay. And that's a good also perspective, because implied volatility, unless you trade the implied vols and know how to hedge, and understand it, besides, IV rank, this is another way to kind of look at it from the perspective, how high are we talking about? What does it usually price in versus what it is now? So now you got, that means 6.7% in premium. That's how much you're paying in premium for straddle 30 days out. Okay. So if there are no questions, Will, since we're doing another webinar today, I could stop right there.
Yeah, no, that was great, D. We did have one question from a new person on the YouTube chat. He was just wondering how he could maybe look at gold and silver and how it's been performing with the move in oil. Is there a way to look? The only thing I can think of is SLV or GLD maybe, and then
So you could use, now these are not exact replicas. It's not. There are futures on gold, silver, and so forth that we do not cover futures markets. So these are ETFs that try to mimic the commodities like gold, silver, SLV. But you got to read about it and see how they track gold. How do they track silver? It's very important if you're going to look at these products. How do they track it? Because if they're rolling futures, it's not going to reflect the performance. Not going to reflect always the exact spot price of the underlying commodity, because if you're rolling futures, you have, you're buying one future, selling the other. If one future is higher than the other, you have backwardation, contango. You need to take those things into consideration. I'm not going to get too much into it, but when you're trading ETFs that try to mimic the commodities, you should read about how they're doing it. What is the methodology? Because there are other risks coming into play. And this is very relevant even in the VIX. Like the VIX is, I think, you got a derivative of a derivative of a derivative, so this is like very, complicated in the long term. There's a big role in the futures that is, it's like a fee, it's like a carry fee, and you need to understand that. So, you can use the ETFs, but I'm not going to right now go into it and analyze it all for you in the next 5 minutes. Just keep in mind, you could go and read about here. You could go, ETF info. You could go here, links, go to the company website, read about it, see how it's tracking it. They might give you tracking performance. Here, how do I close this? So, because you don't want to get caught kind of thinking you're buying something because you think it's going to track the performance of gold, and it actually doesn't. That's, and people, I think with these leverage ETFs, they got caught thinking that they're tracking the performance of something that it wasn't. So, before you do that, I would say go look at the ETF, see how they track it. If you want to try to, mimic the performance of gold or silver, or you could go in the futures markets. We don't cover that.
Michael McRae is asking, is there a way to look at the correlation between two ETFs?
So, if to make maybe something quick, if I just took say 1 year, and here's the price performance of gold, but if I put in something like SLV silver, this kind of normalizes it to percentage moves. So, a year ago we start how they performed over the year. So you could see that, there's it's not a 1-for-1 correlation just visually. I'm just saying just visually here alone, because you could see how GLD versus SLV performed. So this will normalize it kind of to percentage moves.
You want to just because we have the show today, your mic's gone a little static again. You just want to plug it in and plug it out, see if that changes.
One more time.
Yeah, that's good. I don't know what's going on. Just went static again.
All right. I'll just reboot my computer after this.
Yeah, it sounds good right now. All right. Okay. Well, that was great, D. Thank you so much, my friend. Another good show for those who didn't hear earlier. Dimitri's doing a show on the IBKR channel today. I put the link in the chat. I will put it in the chat again. Great job, Dean. Thanks so much.
All right. Thanks, everyone, for joining. Stay safe out there. Hope to see you guys later today, 2 o'clock, or tomorrow. Thanks for tuning in.
All right, chameleons. Have a great trading day.